Hello and welcome to the Repeating Podcast. My name is Ayush and we have Chaitanya and Sagar back on the panel once again this weekend. Say hi, guys.
Hello.
Hello. Okay, great. So we are recording randomly at 8 p.m. on a Thursday so that we can get stuff done before the weekend. But this
There's
week's
a
topic
liquor
is
ban in
also,
Bangalore on Thursday.
yeah, so clearly there's a lot of productivity happening.
Yeah.
House party after this, guys.
Yeah. But this week's topic is a little different. We're not doing a stock or we're not doing a company or we're not doing a country view. We're looking at an asset class that has seen a 10x growth in the amount of money that has been put into it in 2023 and is a way for you to actually almost directly invest into, let's say, an office building where you can get rent directly credited to your account based on how much you invest in this particular asset. Or if you're going by a highway and you pay toll, some of that toll could actually be directly credited to your account because of you investing in this asset class. And these are called REITs and InvITs, or real estate investment trusts and infrastructure investment trusts. So yeah, they've been gaining a lot of traction lately. In fact, I think in the US, this is a fairly large market. Here, the penetration is not as much, but it's slowly gaining a little bit of traction because instead of investing directly into buying a house or buying a road, which is something not most people can do, and going through the volatility of a lot of real estate stocks and the corporate governance, this seemed like a midway where you get direct exposure and is a little less risky. But I mean, unfortunately, the kicker here is that performance wise, REITs and InvITs haven't been doing really well in the past year at least. Where if we take just the sectors, so real estate, one of the best performing indices of last year, 81% returns, but the best REIT gave a negative 1% return.
Ouch.
Similarly, the infra index gave like a 38-39% return in 2023, and the best infrastructure InvIT gave a negative 6% return. So clearly, there's something going wrong, something that's making this supposedly sexy instrument not so sexy in terms of returns. So we're just going to look at a couple of reasons as to why this is happening. What is that gap in terms of this looking like a cool instrument, but it not actually translating into one, and what could be happening in this space in the next couple of years that is resulting in people still investing in this instrument. So, yeah,
They must be
that's
paying
crux of it.
distributions, nah. That is also
So
not good.
the question was that when you say negative 1% or negative 6%,
Yeah.
have you looked at a price return index or have you looked at a total return index?
So
TRI.
this is specifically price. Now, if you have to look at a
That's-
total return,
Yeah.
it's not very different because, okay, let's say we take, so in 2023, it was the year when, for the first time in India, a nifty REITs and InvITs index was launched to track all of these REITs and InvITs. Whereas, where this best REIT, which is Embassy REIT, and the best InvIT, which is India Grade InvIT, have about a 50% total weightage. So they basically drive the entire thing. So while price wise the index hasn't moved at all, on a net based on the distribution income and everything, while the index is given a 1% return from April 2023 to now, which is April is when it launched, the actual net return is about a 4%. So inclusive of that distribution income that you're getting
Now the
like an
inflation
additional
खा गया आपका.
I mean, yeah, unfortunately. Plus, I mean, as we proceed, we'll see how tax also almost entirely gorges down on that 4% return also. But yeah,
But do you
I think,
quickly,
yeah,
two-line want to give a what are REITs and InvITs?
yeah. Wait,
Like
Chaitanya,
Yeah.
how about you give us the intro?
Okay, so it's a kind of a pooled investment where multiple investors' money are pooled together, and the REIT company basically they create a special purpose vehicle to invest all this money into assets. Like if it's in a REIT, then it's a real estate. If it's InvIT, then it's infrastructure asset. For example, highways, as you mentioned, and also power infrastructure. So why SPV? That's the question. Because there are some benefits which are provided to SPV, like dividends are tax exempted at the rate level, and interest income received by SPV to the asset owner, basically, which is the REIT company, that is also tax exempt, but that is on the rate level. Interest income is again taxable at your personal level according to your tax level. So that was about SPV. So yeah, basically it's a mutual fund of real estate or infrastructure portfolio. If you can sum it up pretty.
Yeah, I think it is very comparable to a mutual fund, given that it's a trust structure.
Yeah.
There is a agency managing the trust, which is appointed by the sponsor. So even in this case, there would be a management company, which is the SPV itself, and all the beneficiaries are the unit holders. And while for mutual funds, you can subscribe directly to a scheme and have your units also extinguished there. In this, to make liquidity far simpler, a REIT or an InvIT has to be listed on an exchange.
Yeah.
So the trading happens, or the liquidity flow happens on an exchange instead of it being directly with the REIT or InvIT. Yeah. So you get, again, capital appreciation as well as dividend income, dividend/interest.
Also,
Which
one
is also
small
why,
benefit of SPV, I forgot to mention, that it's a bankruptcy remote structure. That means, for example, if anything happens to the sponsor, for example, if it's an embassy REIT, and for example, any kind of problem happens with embassy on a corporate level, the SPV will not be affected by that, and the unit holders' money will be safe and secure. So that's why it's a bankruptcy remote structure.
That's pretty cool, actually. That's a nice fact.
Yeah.
And that's so
And I
starkly
think,
different from the
yeah,
normal perception of real estate investments, right? Because
exactly.
if you're making a physical real estate investment, the builder's going to vanish, there are going to be delays, the ticket size is going to be large. You're going to have to get into operational stuff in order to get your property rented up. Infrastructure, obviously, unless you are like a company, you can't even participate in, unless through equities or bonds. So REITs and InvITs, from that standpoint, just from an investability standpoint and accessibility to retail investors, just make a lot of sense. But what doesn't make sense is that the performance of REITs and InvITs is not really in line with how the infrastructure sector or the real estate sector have performed, at least in the last 1 year. So
as a concept, it is very cool, but yeah, the story, because also there was another rule, which is like 80% of the assets should be income generating, already developed. There shouldn't be anything which is underdeveloped or yet to be developed. Yeah. So, but the story of price of rates, they're different.
yeah,
that's true.
so yes, what Ayush is the number one reason why there is a sexy in this instrument and this
Non-sexy about this sexy thing.
So I think actually, building off of what you just said, right? 80% of all the assets have to be income generating, and also 90% or 80% of the income that is generated is distributed to the unit holders. So the actual REIT or the trust itself doesn't retain a lot of the earnings that they make. So that doesn't really drive price as it usually does on a stock exchange or the stock market level. So that's probably one reason. The second reason could also be that I think so. As we said, like, there's a 10x growth in terms of the amount of money that went into REITs and InvITs, but a lot of that 11,500 crore amount has gone into unlisted REITs and InvITs because, however, a deal was created by those investors, they must have not opted for the listed ones, clearly, because price almost didn't move at all, even though such a large sum with such a low liquidity base should have resulted in a price appreciation. So there's also that, where there's only like 30 REITs and InvITs available, out of which only 5 are listed on each side. So people are also choosing, because there are high net worth individuals and institutions involved in this transaction, they're opting for the unlisted ones first, because they seem to be getting a larger yield, maybe, or a larger distribution, or a larger chunk of the entire pie.
Maybe because sponsor also think that it is better to have it distributed among few private investors who understand the assets and also who have the patience to go through whole journey. So
Right.
maybe that might also be another reason.
Another reason also could be that, so as we said, right, there's like this income that you're getting, and most of it is like distributed on a quarterly basis. So just like how usually we see in stocks, right, where ex-dividend, the stock price falls. This happens here as well, where right after the distribution income is credited into the account, the person exits completely out of the REIT or an InvIT. So the rally is not sustaining enough to even create that much of a dent from a capital appreciation perspective, because there's no conviction in remaining invested with the REIT or an InvIT.
Yeah, there's no growth element if we want to sum it
Yeah,
up.
there's no incentive to stay invested until you get that, and that investable income, or is rather the income you're getting from it, is also extremely low. So you're just taking that little bit and basically fucking off from the entire asset class. So that's one reason why people aren't staying invested, or why there's no excitement in this space. Second is this, like the income that we were talking about, it's so low. It's low in the sense that for each unit, you get about 12 rupees a year, and that's about 3 rupees a quarter.
What do you mean
And
12
that's
rupees?
On 100 rupees.
on every, so based on whatever the NAV is. So NAVs of these are usually between the 100 and 150.
But that will
Or,
fluctuate, right? So you have to look at the
yeah.
percentage yield and not like an absolute level 12 rupees or whatever.
So if you're talking about yields, then REITs have a yield of about 6 to 8%, and an InvIT has about a 15%.
15% yield is not bad, really. I think,
Yeah,
I don't think you can say.
infrastructure wise, it's nice. But the only problem with that is, again, and why this income distribution thing is flawed, is once they set up an InvIT, and most of these are very recent, so 2019, 2021, they don't grow on a year-on-year basis. So they start with one pool of assets. So it's going to be maybe 4 highways under one trust, or they have a couple of solar plants under one trust. They're not expanding their portfolio. So that 12 rupees is going to remain 12 rupees, because the occupancy rates or the usage of those highways also remains maximum only to an 80 to 85% on all of these.
Also because incomes are going to stop now, because they can't collect the taxes perpetually. There must be some deadline. So that also maybe.
But the thing is, I mean, that's one positive, in fact, because the deadlines of these are like insanely long drawn. For example, I think
2037, 40.
Yeah. So, for example, I think for since both of you are from Bombay or have visited Bombay, you know the Vashi toll bridge, right?
Yeah.
So it opened way back in the early 2000s, but the actual deadline for when they'll recover the entire amount via the tolls is maybe 2050.
So payback period is very high.
Yeah. So now we see so many of these newer highways coming, the Atal Setu bridge and all this, charging a 250 toll one way. For it to reach that whatever amount that has been spent on it to be recovered, it's going to take a couple of decades. So that's one good thing, where there is longevity in terms of the income, but the income is not going to grow. So that yield also remains stagnant, which is also why, while looking at yields for this particular instrument, previously we said it's comparable to a mutual fund because it's pooled assets and all of that. But here it's also comparable to a bond, where there is price appreciation and there is distributable income coming. So you're looking at it from a yield perspective. And sometimes these InvITs and REITs look attractive, but I don't think in recent past a bond has outweighed in terms of benefits when compared to a REIT or an InvIT.
I don't know. You're still, I think, getting it like undermining the benefit of it. If some asset is giving you 15% yield, I don't see anything negative in it without any capital appreciation as well. Because you're getting a 14-15% yield, it's pretty healthy, bro. And I think what's shading the opinion is the fact that you're in a bull market and something else is giving you better returns at this point in time. But if I were to get 15% consistent yield for the next 7-8 years, why would I not even opt for it?
But is it consistent though, the 15%?
It doesn't waver a lot.
Okay.
Unless your NAV catches up and increases further, your yield won't drop.
Yeah.
And for your NAV to catch up significantly, what will have to happen is that your it would be probably looked as a safety asset. So the moment probably equities start faltering or enter another phase which is different from the current phase, people won't really look at that. Dividend yield doesn't work at this point in time, right? You want capital appreciation because you're getting it easily in the markets. So if you enter a 2-3 year period of the markets being a little choppy, you might just see NAVs starting to bounce and that yield coming down. So it might just be a temporary factor. But I think on the longevity, while certain assets at a later point in time will sort of extinguish, there will be newer money deployed in newer assets, right? So at a portfolio level, you will still maintain a base of paying assets and high equivalent to occupancy from an infrastructure perspective.
Yeah, that's true.
Question is
how is
the 15% when it comes to, and that's where it will probably make a difference, is 15% when it comes to the hands of the shareholders or the unit holders. How does that change or reduce because of various costs implications, including taxes? And I'm saying various because you'll have to account for a brokerage, for a management fee, for etc. Versus how it comes down in the form of an equity dividend yield, a bond coupon, and dividends via mutual fund, for example, or fuck off mutual funds. We don't care right now for simplicity.
I think Chaitanya is well versed in this aspect.
Bit because it's again like it depends on the option you choose, right? Whether you want it payout or whether it has to be reinvested, and it is only on the distributable income that you can pay a dividend as a mutual fund. So let that aside. Only equity, bond, REIT/InvIT.
Yeah.
So also before coming to the tax point, the reason I asked about the consistency of the distribution was I was reading somewhere about the IRB infrastructure InvIT. They are into the highways, right? So their cash income was disrupted by the farmer protest. So they even that happened like way back, approximately 2 years back. They still haven't received that whatever the disruption they got. The government confirmed it that they will compensate them for that, but they're still to receive. So that's why there also might hurt the distribution.
That's quite like an extraneous variable situation, right? Where an entire bridge is shut down for that long, where it creates a dent in the net cash.
So that might be outlier.
It was a one-off,
but
but it's possible. Like it's not impossible.
But let's come to the power example now. If the power demand also varies depending on the seasonality. In the summer it's peak, so the revenue generation, so that also is reflected into the distribution. For example, quarters after the summer quarter is high distribution and the winter quarter is lower. So the aggregate makes 15%, but it also varies.
Yeah, but I don't think that
you're looking at the wrong angle itself, right? I mean, for a company with, for example, a company with seasonality in it, do you think the price moves as the season moves? No, people sort of understand that there is seasonality in the business.
And so it is already priced in kind of thing.
Yeah, so Dabur does not become sexy in the winters because it has got Chyawanprash and a winter portfolio. IT does not suddenly start looking good in terms of valuations in Q1 and Q2 because they're the strongest quarters. It doesn't really work that way, right? Because it evens out, and at the end of it, like to your earlier point of something being like non-functional, and I think that's the benefit of it being a portfolio, right? Because your concentration risk obviously reduces. So even if you've got one bad asset, at the end of it, the market knows that there is a bad asset in whichever InvIT you're talking about. And if the fair value of that asset is 100, people would start paying only 96, 97, 98 for it. So what is lacking in the form of a dividend gets made up for in terms of a lower price, and hence the yield will always sort of adjust itself.
Even out,
Got it. So the price appreciation, it's sorted out. That's not going to happen. So let's come back to the thing which is earning, which is distribution per unit. So that is also
point there, unless in terms of price appreciation, in terms of if there is this asset which is priced lower in terms of fair value, but you know that there is resolution coming by, you might want to take that advantage. The second price appreciation that might happen is when newer assets are deployed, you might want to make a call in terms of how efficient the management is in terms of deploying capital. So are they better than others at deploying capital, and hence do you want to take a bet before in terms of where the or how the portfolio overall will look? And probably also to consider is the fact that at all points in time there will be a price risk, which is a price difference between the traded price and the NAV. So if you see that there is a difference there, probably there is an arbitrage which can be taken care of. So I think all we can result in a certain amount of capital appreciation, and it won't be like a no price appreciation zone.
Yeah.
So if it's trading at a discount, you can catch an arbitrage there also.
Yeah. Unless the portfolio is just that poor that the discount is valid.
Discount
which is
is
also the case in a couple of these
correct.
InvITs where the assets itself are so dead that some of these are trading at like a 20-30% discount to NAV for a reason. Whereas in the case of, let's say, India Grid InvIT, for example, I think sometime in December it was trading at a 13% discount, and within a month that discount completely vanished. So that arbitrage opportunity got taken care of there itself. So that capital appreciation does exist.
Or maybe it's just a bull market now, you never know.
No, again, it's actually what Sagar said, right? It was an expansion of portfolio. They had acquired a new solar project that was quite attractive looking and was seen as something that would mature within a couple of months as opposed to a highway or a power plant. So that was like an attractive moment for India Grid. But again, it's moments. Like you have to really catch on to these and take
catch on to, timing matters a lot.
Brief history of this, right? So once you realize, for example, that a certain REIT or InvIT is very good at deploying incremental capital, or the opportunities are fairly, say, in sunrise sectors in the case of some infrastructure asset which wasn't so earlier. So there's a portfolio tilt. You might just see a situation where, like, the premium that you get in terms of valuations for stocks, you'll probably start seeing in terms of
premium for REITs and InvITs also.
And
that'll be very
just
new for India, though.
Outlook of like how capital deployment will be, or what kind of assets will be picked up by.
But that'll probably be like an industry first for us, because while the industry itself is still nascent, it is seldom seen a case where price has, there has been a premium on the NAV. So it'll be interesting to see whether which InvIT or which REIT eventually gets up to that level.
Yeah. That's why it's not good yet.
Yeah, exactly. It's yet.
Yeah. So coming back to the distribution, it is not a simple dividend kind of thing like you receive in share. There are multiple parts of which the distribution is made of. So first of all, the distribution comes from a simple rental income or whatever the toll income, or in this case of power, it's that income. So that is the first part. Now taxes about all these parts that the distribution is made of. It is taxes also different for this. For example, this rental income that I said, it is treated as a normal rental income. For example, if you have rented your own house or your other property, so it will be taxed according to the investor's tax slab. So that is one. Now the special case that we talked about, forming an SPV as a dividend income receiving from an SPV to the sponsor, and as an income, because as we said, 90% should be distributed among investors. So for growth, they have only one option left, which is debt. So the debt is issued to SPV by sponsor, and the interest income is given to sponsor by SPV. That the both two things, distribution received from SPV to sponsor and interest income, those both things are tax free. So but at the rate level. So again, the interest income will be taxed at investor level as per tax slab. Distribution is not. So that's a hopefully good thing. And also repayment of this, whatever the interest income is there, but also there's going to be a repayment of principal of the loan which has been given to SPV. So that repayment it's a kind of tricky. So what happens is, for example, let's say you bought it at 250, NAV is 250, you bought it at 250. Now the repayment of this income, whatever it's in your share, that will be exempt until
Sorry, repayment of interest, you mean?
no repayment of principal. Interest to ho gaya na,
But the investor doesn't get the principal amount ka. Only gets the interest.
But sponsor get no. Ultimately, sponsor will pass it through.
Of course. But the actual DPU or the distribution income, it's split into rental, as you mentioned,
4 or 5 parts,
and interest income. These are the largest. So interest income is what the SPV is repaying back to the trust, and then the trust trickles down that interest income to the investor. Of course,
principal also get repayment. Na? So the
trust
principal
gives loan to SPV to build portfolio.
Whatever they want to build.
SPV repays loan to trust, and that interest income is distributed
that
to
repayment
the
is also
investor.
made of 2 parts, na? As an income, interest income.
But like just to simplify it, because it gets, as you said, right, it's too complex. Which is also a reason why people aren't investing in these on a retail level.
90% of the people watching this have zoned out already. You want to restart it in a simple manner.
No, but the repayment part, it's important to mention because that is not how normal income, interest income is treated in terms of taxes. The repayment is tax-free until your NAV, and above that, it is taxable at your level. So that whole part is not.
So basically, as you said, like an example, if you bought the issue price of the REIT is 300, you get an interest income of 30 rupees a year. You have to wait for 10 years for this 30 rupees to be taxable, after which it will be taxed on your tax slab.
Interest income is taxable. For example, if you get 50 rupees as a repayment.
That's the case now. But
that's
prior to 2023,
interest income was so taxable since start. It's the repayment wala part that was amended in the latest.
I think you are confusing him further. You have to get your concepts clear.
Cool.
Because there are two components. Yeah, there is an interest income and your
principal repayment.
1 second. Shut up, both of you. There are two components. And you use the terminology right and you don't interfere. Now, what are those two components, Chaitanya?
Two components is first is interest and principal repayment. Second, like how simple how home EMI में कैसा होता है? You play interest and principal every month.
1 second. So interest payment that happens is taxable to the investor at his tax rate. The principal repayment becomes taxable only once the cumulative principal amount repaid exceeds the NAV which is underlying.
The issue
which the investor has bought at.
Uske baad hi
after that it's taxable.
The tricky part is that initially your principal component in any loan is always going to be smaller compared to the interest part.
Component.
And over the duration of the tenure, your principal keeps getting bigger and the interest keeps getting smaller. So for an investor here who's getting taxed, for your entire principal to become taxable is anyway a long haul process. Right? So your initial bid is going to be taxed higher, initial receivable, whether it is interest or cumulative receivable is going to be taxed higher. And over time, you are going to not hope that taxable portion is going to keep reducing till the time principal hits NAV. And then again, it sort of bumps up.
But this benefit, the principal hit NAV, it got tax exemption. That is quite off if you sell it in between. So that goes that benefit also.
Yeah, of course. So you have to hold.
You have to hold it until it matures or whatever. Yeah.
Okay.
So the tax rate is also a very tricky part, and that's why and this was the new one, the latest one we talked about. That was introduced in 2023 budget. So that also might have dented the sentiments of, because let's be honest, most of the investors are going to be institutional, and they are not going to be someone who is earning less than 7 lakh a year. So they're going to get taxed.
Cool. So we've covered 3 points.
Feels like I'm doing CA class for no reason.
But you do give out slow vibes.
Maybe it's the family.
Let's just clarify that Sagar means that as an outright insult.
No.
No.
This was
even if he means it as an insult, I take it as a compliment.
It is.
Chaitanya has the letters CA in his name. It's a sign.
Start with C, ends with A.
Yeah, that's what. Hetan here is in between.
Let's continue with.
Yeah. So we've covered 3 points. 3 points as to why, I mean, debatable as to why it would be an apprehensive choice to choose a REIT or an InvIT. And still, like, people are investing into these increasingly, where if 2023 saw 11,500 crores, 2024 might just cross a 16,000 crore mark in terms of collections into the REIT and InvIT space, both listed and unlisted. And this catching up to the pre-COVID levels of 20,000 crores going into REITs and InvITs that was the first year. So that first year saw 20,000 crores. So yeah, there is excitement, but there are also apprehensions. So it's just a time of when this space looks a little more exciting. And I think there are a couple of things that are happening on a central government basis, on an industry basis, that might just make this look a little more attractive in the coming years. A couple of these are that I think just simplification of this entire process. The fact that we took 10-15 minutes to explain this clearly states that there's a problem in understanding. Yeah, not just the taxation, but understanding of the actual instrument also has to break. That barrier has to break. So the
Make
government
sure this video gets reached to Nirmala Sitharaman.
Yeah, she's going on YouTube and checking. Yeah, let me look at the opinions of
repeating. No, someone can share her, no?
Yeah, of course. Sure. But yeah, that's sort of what they're doing, right? Where they're trying to standardize the process, simplify it as much as possible. And that's why I think they've started a new REIT council sometime in 2023 November, where they sat down and discussed the same exact problems that we are talking about in the course of the podcast. Yeah. Apart from that, mutual funds are getting very interested in the whole REIT and InvIT space. While currently there's maybe 1 or 2 mutual funds that have actively invested into REITs. I think one of them is Kotak and Invesco. Not a lot of people are capitalized this option yet, and the mutual fund industry is urging SEBI to create a completely different category for a REIT mutual fund or an InvIT mutual fund, because at some point in the next 5 years, the number of InvITs and REITs are going to at least double, where we're going to see 5 new ones coming in just in the next, like, maybe quarter or so, with DLF and Godrej and all of that coming in. So to accommodate for that change, simultaneously regulation change to ensure that it can accommodate for a pooled version of a pooled asset.
Okay.
So that seems a little more attractive.
Mutual fund of a mutual fund of a real estate.
This is like an FOF type situation.
I
think it's better than this thing, right? Like, I would, as an investor, even if it's an institutional investor and I've been given a mandate of doing a real estate fund, I'd feel much more comfortable having a portfolio of REITs and InvITs than a portfolio of stocks, for example.
Yeah.
I mean, a mix of both, but like strictly if I have to invest in Godrej plus Oberoi plus DLF plus whatever, I would rather invest in some REITs just to safeguard my principal. Plainly from the standpoint of infamy of, like, or the track record of real estate players in terms of governance and in terms of how much can go wrong. And you've got so many of those examples, right? Right from like DLF at a point to Unitech to HDI. Soba still like better, but like so many of these bad examples where like stocks have gone 1/10 or non-existent, and plus combined with the cyclicality factor, where the last so many years have been dud, and suddenly you've seen such an interest in the last 2 years. And now again, you're like, hey, if you're not in the luxury real estate space, there's nothing.
Then it's not gonna work.
The only people queuing up are those that don't like queuing up.
Also, on the bankruptcy point, that's where the SPV structure also comes in.
Yeah, exactly.
Yeah, so that is also
so
there. And also
sense to have those dedicated funds on REITs and
newer ones also are the residential one, no, I think.
Yeah, so I think the first residential REIT was last year. It launched called Nexus. Now DLF and Godrej will be the next two, and it'll be much larger in size. So the DLF REIT might just become at par with Embassy.
Poster boy of REITs.
Yeah, poster boy of at least residential REITs. It is going to make a banging intro into the market. Whether it does well or not is yet to be seen, of course, because there's no documentation as to how it's going to be structured. but it might just make a splash. So yeah, there is tailwinds, or at least mention of tailwinds happening in this space. But until then, I mean, I guess after the end of this conversation, it seems like it is a decent asset to keep as a safeguard, but not to expect massive capital appreciation or insane returns from. So it's a good hedge or a good safety
That
net.
expectation is pretty hard in this market. So maybe
Yeah.
currently, though, staying on the sidelines is the best thing to do.
But I mean, additionally, these also give you protection against down cycles, right? Because the yield adds to the step. It's like a bond. I mean, why would you care if
It's
the
a predictable cash flow machine, basically.
Yeah,
exactly. So
it's quite predictable. That's true.
So I'm still sorry. Later.
No. You're still what?
Yeah, I was
pro
talking about changes. I can't. Yeah.
But it's yet to be seen whether this makes an entry into repeating or not.
Yeah, it's definitely been considered for a while now.
Yeah. Too long. We missed the India grid rally because of it. But yeah.
Yeah, I mean, you'll get options.
Yeah, for sure. It's still very early.
Additionally, I think, equity markets also have been dicey only since the beginning of the year, right? So, you have enough time to realign.
Yeah.
So, where should one invest? Buy a shop, buy a bridge.
See, clearly that's out of the budget of definitely most of us. And no one's settling for something that grows at negative 1%. Equities
but I have
might be just
I used first for Chaitanya. If you had to invest in one infrastructure project, okay, you have enough money. You have been given the choice of, you can own a highway, you can own a power plant, you can own whatever. What would you own?
Adani.
Adani, company you can't own. We're talking about an asset. You can't own a
particular project
or a man. If you want the man, you can.
That is on a different part of the internet.
Infrastructure asset. Railway, then I think it makes sense more.
Ooh, yeah.
That is interesting.
That's an interesting pick. Yeah. Ayush, what's yours?
I mean, power transmission lines seem to be the next big thing in InvITs. So getting
distribution loss power.
Yeah, but it doesn't have to be coal power, no.
But it'll get better from here.
That's
power distribution loss.
Not as much as normal power. Like, it's cut by about 25-30%.
Maybe you should own hydrogen power plant.
Yeah, so something like in the future forward-looking power sector, because that seems to be a good place to.
You have to name it. You have to pinpoint and say.
Future, so I also want to invest in.
It's very interesting. This India Grid project that they've recently acquired. It's spanning across Gujarat and Rajasthan. It's a massive solar plant that they're planning on extracting and selling to discoms, and not using any of it
themselves. Many other things now. I have to choose one from the listing university.
Hey, nobody criticized your holding so much.
Yeah.
Okay.
But
it wasn't worth criticizing. That's why.
Because you didn't provide any structure to it, no, or backing.
Interesting
but it doesn't track one particular journey I wanted.
Really. Yeah. बड़ौदा से मुंबई वाला है सागर ही मेरे को कमा के
Nice. So आयुष वो पहले गन्ने के खेत में करते थे ना आयुष 2 पैनल्स के बीच में he'll be fucking.
Oh no.
Electric feeling.
It is electric indeed.
Yeah. Gen Z version of गन्ने के खेत में.
What about you, Sagar?
Wow. I think I would own a nuclear power plant.
You think that's going to go somewhere in India?
I don't think government's going to allow that, but yeah, anyway.
No. This is like barring all logic. Well, like that way, you can't own a fucking railway track either. कौन
I
करेगा?
walked right into that in time.
Yeah.
Yeah.
Like that, feasibility wise, only mine is feasible. But
Correct.
do you see nuclear power being something that
Yeah.
lucrative?
It is the most efficient fuel, basically.
Yeah, but
It
isn't
is.
it also?
I just think at this point, I mean, wherever it has been deployed at scale has been at the wrong places. Japan is the one which is so prone to earthquakes and tsunamis. You fucking build power plants over there. मतलब
Yeah.
क्या फायदा है इसका?
Yeah,
I
that's
think
also true.
Scandinavians is a good example.
Yeah, that is a good example. Not like Japan. Like, I mean, the world is all like full of this shit, right? Like, whatever you're not supposed to do, countries end up doing. Like India producing cotton, for example. Why? अरे देश में पानी नहीं है. Cotton is so water consuming. You will become the world's largest cotton producer, along with Egypt, which again doesn't. Like, it's just senseless. So I think there is a potential for nuclear power plants in India, strategically located, given the geographical sort of expanse that we have. There is a case for it.
बेंगलोर में जाते ही पानी की कमी दिख गई.
No, not where I stay, man. Posh.
Central.
Yeah, central Bangalore.
Yeah, coming to the real life. What
Yeah.
is
So
the
if you had to, okay, now the question turns. If you, instead of REITs and InvITs, had to own or get exposure to this area, what would you get exposure through, Chaitanya?
currently looking at my bank account, REITs and InvITs only seems the feasible choice.
No.
I can't own
there
an apartment.
No, like of course not.
Uh,
But there are
Like in financial instrument space, financial
Yeah.
assets, not physical assets. Like that's why I said shift from physical
Okay.
assets to financial assets.
But that also depends on the investor's risk tolerability and all those things. Now, I'm pretty
yours.
I'm not risk averse, so I would like owning even micro caps for that matter.
So Chaitanya is
Forget even
aggressive, I
large
am
cap.
conservative. So we can have two different opinions.
So you saying small cap equity in real estate
Yeah.
and infra.
Direct stock, not even mutual funds.
And that's where I'd go. I'd go mutual fund.
Huh.
I mean, some of these ones have done really well, like the ICICI Prudential one and the HDFC Housing one. I think it's got like 30-40% CAGR over the past 2 years because they, I mean, obviously.
Or maybe small case by the company. I think it was repeating. Yeah, they also put.
Yeah. That was.
Everyone is marketing
Yeah.
here. Everyone is marketing. Everyone is part of everyone's job profile.
Why are we hiring when we can just do it ourselves?
So,
But yeah.
small cap stocks, mutual fund, and you, Saga.
Balanced.
No, I think mine is. So this is the thing, right? Like I think I would do stocks when the time is right, but I would shift to something safer when the time changes because the industry is so cyclical. I think I would keep hopping between equity and bond-like or debt-like instruments. I don't think real estate, at least, is a sector which, for retail investors, it's great to have some massive exposure towards in terms of concentration because they already have their hopes, right? So you've already got like a large chunk there. So for retail investors, I don't think it makes sense, man, to be like heavily exposed in the sector. Small bit is okay, but for someone who's professional, you might as well keep hopping between equity and debt-like instruments depending on the time.
Again, description, nothing we say is an investment advice. So you can consult your investment advisor.
Thank God.
Or you can connect to us.
This is compliance plus marketing.
Yeah. My God. You really are a CA, aren't you?
What a founder.
Yeah.
Cool. With that,
yes, thank you all for watching. Stay tuned for the next episode next weekend, and until then, that's a wrap.